Hi, so obviously from the title, today I'm taking a closer look at Etsy, the e-commerce company that provides a marketplace for handmade or vintage items and craft supplies. These items fall under a wide range of categories like jewellery, bags, clothing, home decor, and furniture, toys, art, as well as craft supplies and tools. Before you go look at the share price, let me save you some time. Now, although the stock price has gone crazy, it might actually still be a good opportunity. For those of you who are new here to my channel, well, welcome aboard. Make sure you subscribe so you don't miss my future videos. And what I normally do when I do a company analysis is I look at the industry they're in, the competitive forces that they face, the management team, I give a valuation and then my opinion. And today I'm actually taking a lot of this information from a Sabre Capital write-up on Etsy, and I'll leave a link in the description. It's a really good read. Now, I also get a lot of requests to cover a particular stock, but please make sure to tell me some real reasons why it's a potential 100 bagger. So that's a stock that can go up 100 times over, say, the next decade or two. So we'll most likely need to be a company under $1 billion in size right now. All right, so Etsy, of course, is an e-commerce platform, and I love good e-commerce companies. The obvious competitor here is Amazon, but I'll address that a little later. Now, to say 2020 was a good year for e-commerce is an understatement. I think the CEO, Josh Silverman, said it really well in the conference call. We roughly achieved our 2023 aspirations in 2020. 2020 was an extraordinary year for e-commerce overall, as the growth rate of e-commerce roughly doubled as much as the offline world shut down. And as fast as e-commerce grew, Etsy grew much faster. In fact, Etsy grew almost 2.5 times as fast as the other e-commerce providers. And here are some of the important statistics. They're now the 4th largest e-commerce site by monthly visitors in the US. 40% of sales is actually international. They had 189% year-on-year growth in just the UK, and Germany grew over 100% as well. Habitual buyers grew 157% year-on-year, and then from the seller side of things, that grew 64%. They now have a $25 million market cap. Look, it's very safe to say online shopping is here to stay, and the industry is one of the best I can think of for reliable future success. And there's still more to come. They've actually only just started expanding their digital advertising, and with all of these new sellers that they got, just like with Amazon, sellers advertising on the platform will be another huge revenue driver. It's practically free money for them. Their total addressable market is huge as well. The world is a big place, and it's not that difficult for them to expand globally. They don't have warehouses, logistics, or inventory like Amazon. Their business is different, more like eBay than it is Amazon, which requires far less capital. So rolling out into the world is fast. This document is from 2019, and Etsy has more than doubled in that time. Even so, there is a lot of growth to come. This is just for the top 6 markets. What about the rest of the world? That's not even included in this diagram. All right, so the network effect here is really strong. Etsy rapidly grew buyers at triple-digit growth rates, which attracted more sellers, which provided more products, which then attracted more buyers. It is this network effect working very well, and this is going to drive strong growth into the future. Networks are great businesses because it becomes cheaper and easier to attract more customers as you get bigger. See, the first 1,000 customers are actually far more expensive than the next 1,000 customers, and so on. I think Etsy has a niche that they are serving that Amazon isn't meeting. See, Etsy is more for, say, artists and bakers and carpenters and other creators. Etsy items are far more individual and unique. Amazon is more about convenience and price. This is not the same as Etsy. They are actually serving different markets. As the company would say, well, Etsy is serving people who are looking for something special. Now, social media sharing isn't the most reliable number to make a decision, as trends change quickly. But Etsy in the biggest Facebook groups average 1,600 posts per day. Compare that to 1,100 for eBay and only 20 for Amazon. It just means that people love to discover and share Etsy products. High gross margins are something I really love to see. The higher, the better. Now, gross margins here for Etsy are at 60%, and even better the last few quarters. This makes them very profitable. Now, this is their book value, and it has exploded. Look, all the growth metrics are insane for the last 12 months. Triple-digit growth across pretty much every metric. So the big question is whether that is sustainable. Now, of course not. 100% plus growth rates are not sustainable at all. But because Etsy is a network-based business, 2020 was a catalyst for good growth moving forward. Remember, e-commerce buyers are growing fast and sellers on the platforms are growing fast as more people look to work from home and make extra money. Think of it like a snowball rolling down a hill. It gets stronger and faster as it grows. Now, my estimates on growth rates at the moment are about 25 to upwards of 35% moving forward. Now, I'm not concerned about Amazon. They serve a different customer. And I think Etsy has shown they are for special products, something that Amazon doesn't really offer. eBay, I also don't think is in the same space exactly. It feels more like Pinterest compared to Facebook. They are both social media platforms, but they are very different at the same time. Maybe something will change here, I don't know exactly, but look, Etsy are just getting stronger every day. Josh Silverman is the CEO, but he isn't the founder and doesn't have a big ownership in the company. That is the first red flag that I see. Look, not a deal breaker, but founder-led companies tend to be better. Plus, I like when CEOs' incentives are tied to the performance of the company. Look, he does have over $20 million in stock and only about a $1 million a year salary. So look, he is incentivized, but I just prefer founding CEOs. This is the return on invested capital for the last 5 years, and it's very big here for Etsy. The 5-year average is about 50%. Look, I think anything above 15% is good, so 50%, that's fantastic. Debt to equity is a bit of a concern. In 2019, they took out $1 billion in long-term debt, which puts their debt to equity ratio well above 1. I normally want this below a 0.7. I don't like this at all, as this is how businesses can get into trouble. But they did borrow this money at very cheap interest rates, and the amount of cash they are producing, well, they should be totally okay. But I don't like this, and this isn't how I would manage the business myself. Then when we go look at the current ratio, well, it's actually well above 4, so the debt is very manageable at the moment. So look, I can forgive them at the moment, but it does invite a little more risk. And when I look at their cash pile, well, it's growing and it's growing fast, and that gives me far more confidence again. The question I have is, what do I think the chances are that management will mess up this amazing business? They have just experienced one of the best years a company could have. So look, bad management will mess this up. Now, Josh Silverman does come across as a smart guy with a clear understanding of the opportunity. He also arrived at the company when it wasn't profitable and probably at a crossroads. He has performed really well so far, but look, the future is impossible to predict. I guess we will have to wait and see, and something that will need to be monitored moving forward. But that return on invested capital is a great sign and something that I would want to be a part of. All right, so the lower the price, the more upside potential we have, plus the less risk we'll take. I like minimizing my risk. So the best way to do that is to pay a price lower than fair value and significantly lower. Okay, now price to free cash flow is the relationship between the stock price and how much free cash flow the company is making. I then factor in growth rates to get a target price to free cash flow number. This is like a really rough way to value a company, but it is pretty good to get some sort of ballpark figure, and then I compare that with my discounted cash flow method. Now, future growth rates is where things get really difficult. Predicting the future is just impossible. Yahoo analysts think 36% growth per annum over the next 5 years. Zacks analysts think 29%. But look, no analyst could have predicted what happened in 2020. So who knows what is going to happen in the next 5 years? So my opinion on this is based on the network effect that the business will experience from 2020. I think their growth rate is going to be about 25%, maybe 30% on the high end. So according to my table, I would want a price to free cash flow number around 40. Currently, in March, it is about 50, 52. So we are overvalued based on this metric, about 25% overvalued. Now, if I look at my fair value calculator, which factors in more information, if you want a copy of this, it's free and it's in the description. Now, I'm going to use 25% growth rates and then a little less after that. I even used a big multiple of 30, far above what I normally use, because this is an e-commerce company and Amazon never gets under 50. So look, 30 doesn't seem that bad considering. So $150 would be a pretty good price in my opinion, which is also about 25% pullback from the current levels. Okay, now what I've done here is I've changed the growth rate to 30%, which I think is totally achievable, now giving us a buy price of about $175. Okay, so the negatives are this. Maybe Amazon can offer a service better than Etsy. Look, I think this is doubtful because not everyone wants to buy from Amazon. Supporting locals and being unique is Etsy's differentiator. The CEO is not a founder, and this isn't a deal breaker, but I prefer founder CEOs. And no super investors that I like have invested. Something I didn't mention yet, but look, no big value investors have bought into Etsy. I wish they had, as this gives me far more conviction. And debt is high. Everything currently says debt is totally manageable and cheap. I just hate debt. They don't need it. I hope they pay it down real fast. And the last point is their market cap is bigger than I prefer. I'm actually looking at companies for $1 billion or less. Etsy at $25 billion is actually pretty big. But the positives are many. E-commerce is a safe, fast-growing industry. They have great compounding metrics. That return on invested capital is really cool. The network effect businesses get more efficient and more profitable as they grow. I love these network effect businesses. They're very profitable. Gross margins and free cash flow numbers are strong, and 2020 was an incredible catalyst. It is like it's 2023 for Etsy, remember? And their addressable market is big too. Plus, advertising on the platform is only just getting started. Now, I'll be wanting to get a better price, potentially starting to buy at $175. $150 is the better price for me though. So do I think Etsy is a good company to invest in? Now, before you go, don't forget to subscribe so you don't miss my future videos, and hit me up in the comments if you have an opinion about Etsy or maybe another proven company that has this big upside potential. And obviously, you will need to investigate a lot further if you want to invest yourself, but hopefully this gets you started. Thanks for staying to the end, and I will see you in the next video.